The entire credit union community appreciates the opportunity to come before you today. Credit unions have always focused on their members. However, the increasing complexity of regulation is taking a toll on the industry. The impact of the growing compliance burden is evident as the number of credit unions continues to decline. Since the second quarter of 2010, we have lost nearly 1,100 credit unions, 96% of which were below $100 million in assets. Many institutions simply can't keep up with the new regulatory tide and have had to merge out of business or be taken over. Credit unions need regulatory relief, both from Congress and from the regulators, including the NCUA and the CFPB. At SRP, our compliance costs have more than doubled since 2009, and we're actually adding another compliance officer in 2015 just to keep up. That's not getting ahead, that's just the keep up style. Many credit unions find themselves in similar situations. A recent NAFQ survey found that 70% of respondents have non-compliant staff working on compliance issues, which takes time away from the mission of serving the members. Focusing on complying with unnecessary regulations keeps credit unions from fulfilling our core mission of providing our members with provident credit and other financial services. My written testimony outlines NAFQ's updated 5-point plan for credit union regulatory relief, as well as our new top 10 list of regulations that need to be amended or eliminated. One of the greatest challenges that credit unions face today is the disconnect between the regulatory agency in Washington and the real world that credit unions and community banks operate in. While regulators have taken some small steps toward relief, too often arbitrary thresholds don't actually consider the risk or complexities of institutions. Regulation of the system should match the risk to the system. One example of a burdensome regulation where costs will outweigh the benefits is the NCUA's new risk-based capital proposal. The new proposal is a significant improvement over the initial proposal, but the problem with the regulation remains. The proposed rule is extremely costly, and NCUA has not demonstrated why it needs a broad brush regulation. Despite NCUA's estimate that relatively a small number of credit unions will be downgraded with this risk-based capital proposal, the rule would force all credit unions or most credit unions to hold millions of dollars of additional reserves just to achieve the same capital levels we currently maintain. These funds could otherwise be used to make loans to consumers, to small businesses, or aid in our nation's economic recovery. We also believe there are serious legal questions concerning the ability of NCUA to finalize the proposal as written. Ultimately, we believe legislative changes are required to bring about a comprehensive capital reform action, allowing credit unions access to supplemental capital. Next, NAFQ believes the field of membership rules for credit unions should be modernized on both the legislative and the regulatory fronts. NAFQ believes that reasonable improvements to current field of membership restrictions include streamlining the charter changing process, revising the population limits in NCUA's field of membership rules, and making statutory changes to allow all credit unions to add underserved communities to their working groups. Cost and time burden estimates issued by regulators are often grossly understated. We believe Congress should require periodic reviews of actual regulatory burdens of finalized rules and ensure agencies remove or amend those rules that vastly underestimated the compliance burden. At SRP, we spent approximately 116 man-hours to fill out one NCUA call report. NCUA's 2014 submission to the OMB estimated the time to do that at 6.6 hours. Something doesn't add up, 116 versus 6.6. There's a disconnect someplace. All regulations must meet the test of whether the benefits outweigh the cost. We always need to have the end game in mind and make sure the regulation matches the true risk. There are a number of additional steps outlined in my written statement, both for Congress and the regulators to provide relief. In conclusion, the growing regulatory burden on credit union is a top challenge facing our industry today. It must be addressed in order for credit unions to survive and meet the mission of serving their members' needs. We urge Congress to enact regulatory relief and hold regulators accountable to do the same. We thank you for the opportunity to share our thoughts today with you, and I welcome any questions you may have.